Hello, in this video on mortgage loan calculation, I'm going to show the process for determining mortgage payment, loan amortization, and home equity value. But before we go into that, I've summarized right here some of the key things to know about mortgage loans in general, beginning with the down payment, which represents your initial equity in the property. And then also, if your down payment is below 20% of the home price, you're going to be paying personal mortgage insurance. And thirdly, there might be mortgage points, which actually are a type of initial fee that you're going to have to pay to secure the mortgage. A lot of times you're not going to see that. And then also be mindful of your credit score. If it trends, if it's below 600 in general, then you're trending towards subprime mortgage, which comes with higher mortgage interest rates if your loan is approved to start with. So I've kind of summarized the score range right there. And quite a few times after you've gotten a mortgage and interest rates are falling, you might wonder whether when it's a good time to refinance. In general, you want to refinance if interest rates have dropped sufficiently low such that the present value of your monthly savings over the remainder of the term of the loan is greater than the cost of refinancing that loan. Keep in mind that refinancing doesn't come cheap, and so these are some of the items that pop up when you're trying to refinance your loan, summarized right here. And then finally, here are four key attributes of what qualifies you to get a mortgage loan: your credit history, your employment history, of course, how much money you make, and whatever existing assets that you may have. All of these in addition, of course, to your credit score. All right, so for this example, we're going to assume that you're getting ready to purchase a home worth $250,000 and that you are willing to make a 10% down payment. 10% of 250,000 is 25,000 bucks. So that's going to be your down payment, leaving you to wanting to borrow 225,000 bucks, which is the difference between these two numbers right here. And let's assume that you can get a mortgage interest rate at the rate of 5%, and it's going to be a 15-year mortgage, and we're going to assume that your property can be expected to appreciate on average about 1.5% per year. So these are the monthly equivalents right here in blue. And so we're going to go to spreadsheet and hook this up. So this is the data that you just saw right here. And so we need to obtain the monthly equivalent, meaning we're going to come out here under the monthly to get these values that you see right here. So you just hit equal and reference the amount of the loan that you're getting ready to take, and then the annual rate is 5%, so click on 5% divided by 12 to get the monthly equivalent right there. And if you want to, you can format this percent wise. Click on this and increase the decimal so you can see a little bit more of the number. And then right here, the term is 15 years multiplied by 12. That gives you 180. So now here's the big deal right here. You're going to have to calculate your monthly payments. Here's your cheat sheet right there. So go there, hit equal, PMT, lowercase, uppercase, it doesn't matter, open parenthesis, and you can see Excel also gives you a help right there. So click on the rate, which is R, that's this guy right here, and then comma, the number of periods, which you see right there. Click on this guy, which is 180 months, and then comma, and then we're going to get the present value of the loan. But before you do so, put a negative in front of it as I show right there, and then click on this 225,000 right there, and we're good to go. Close parenthesis, and that's your monthly amortized payment. It's an annuity because it's the same amount every month up until the loan expires 180 months on. All right, so we're going to assume that your personal mortgage insurance fee is $30.25, and so when you add these two together, this is going to be the total monthly payment that you're going to be paying. And again, remember, this amount is because your down payment is less than 20% of the loan of the home price. All right, so and this is an assumption we're making that your property is going to be increasing on average at 1.5% per year. So divided by 12, you're going to get this 0.125% per month. All right, so here we go. Let's go ahead and hook up the loan amortization schedule. So come here, click right there, equal, the beginning balance of this loan is going to be 225. So click on this guy right here, All right, and enter, and let me go ahead and clean this out. All right, since we already know that we're going to be working with these right here. So the monthly payment right there equal, click on this right here highlighted for your interest. We're not going to be using this because remember, this is the loan amortization schedule. All right, so then go here, interest due is going to be equal the monthly interest rate, which is this, multiplied by the beginning balance of the loan right there. All right, and then the principal repayments hit equal is going to be the total monthly payment you made minus the interest due for the period. All right, and then the ending balance on this loan is going to be the beginning balance that you see right here minus the principal repayments that you just made. So this is the ending balance at the end of the first month. Now then, in the second month, that's going to be your beginning balance. So go ahead and hit equal and reference this number right here. Right, that's your beginning balance in the second year, in the second month. So again, your monthly payment is the same. So hit equal and click on this guy one more time. All right, and the interest due here is going to be equal. Click on the monthly interest rate multiplied by the beginning balance right there. All right, and that's how much interest for the month. And then principal repayments would be equal to the total monthly payment right there minus the interest due. What's left over is how much of the principal that you're paying back, making the ending loan balance to be equal to the beginning balance minus the principal repayment right there. So now when you do it for the second month, you're ready to copy down, but not before you do two things. First of all, monthly payment, remember, this needs to be permanent from month to month. So click on this. All right, on the second entry, and hit the function key F2 on your keyboard to edit the cell, and then over click it, and then hit the function key F4 on your keyboard to place the dollar signs around it, which makes the cell to be invariant. It's not going to change as you copy down, and you can see it right there. And then also right here for interest due, click the function key F2 to edit. This cell right here, D7, is the cell for the monthly interest rate. It stays permanent, so we need to click over it, and then go ahead and hit the function key F4. All right, so the rate stays unchanged. So now go ahead and highlight these right here on the lower right corner right here. You're going to see the cursor turn into a black tiny cross. You may not see it in the video, but you're going to find it. So go ahead and double click, and that copies it all the way down, all right, to month 180, all right, which I actually pre-populated before I did this analysis. So you can see that this is a fully amortized loan right there. So now that's all there is to it. Now though, a couple of things that may be delightful to us is to observe how the home value changes from month to month. So click right here, hit equal. Remember that this property is initially valued at $250,000. All right, that's the initial value of the property. So now by the end of the first month, we're expecting it to rise by 0.125%. So times open parenthesis 1 plus, click on this right here to tell us what the current value now is at the end of the first month. So you can now see that your equity value, it's going to be equal to, and here's your prompt right there, the down payment that you made, remember it's your initial equity, plus the principal repayments that you made toward paying off the loan in this first month right there, plus the change in the home value. So you're lucky, the home has inched up a tiny bit. So by how much? Open parenthesis, the current value minus the initial value right there, right? And that's by how much your property has gone up. So that's a pretty decent amount right there. And if you want to look at your equity as a percent of the home value, all right, so what we're going to do, actually I want to make sure that you see clearly what this is. So go ahead and do it like this. So it's percent of home value. So click there, hit equal. This is your equity, all right, as a percent of the home value divided by this guy right here. So now you have 10.45. Your equity is 10.45% of the home value, which is 0.45% greater than you started out. So now, how about the second month? So now the home value is going to be equal to the value before it multiplied by 1 plus 0.125%. So now it's bumped up a little bit more. What's your equity right now? Well, your equity is going to be equal to carried forward this number plus, now we're done with the down payment, so now let's look at the principal repayments, which is this guy right here, plus the change in the home value, open parenthesis, and that's going to be this amount right here minus this amount right here. That's the incremental value to your property right there. All right, which makes your equity as a percent of home value to be equal to this number divided by the home value right there. So it's gone up a little bit more to 10.9%. Let's go ahead and just copy it all down now. But before we do so, click on this, hit the function key F2. Keep in mind that our assumed appreciation rate of 0.125% should stay fixed. So over-click it and hit the function key F4 to make it permanent and hit enter. And that's all there is to it. Now we highlight these and then we double-click. And as you can see right here at the end of the journey, you find that your loan has been paid off and now you own the title to the property. It's all yours. Fair and clear.